all of a sudden we are trending that direction. There's a couple of things you need to look at. Why do I think this? Firstly, 124 months of economic growth. And this is massive. I went back to post-World War II. Basically, the time between recessions is about 5 years. We've doubled that. We're over 10 years into an expansion. When did the last recession end? Any ideas? I will tell you.
2013.
Pardon?
2013.
No, the last recession ended in June of 2009.
No.
So it's been over 10 years. We're due, quite frankly. And so, just given anything else, businesses always work in cycles. The cycles over time are being stretched longer, but it is still a cycle. So at some point we are going to see a turn down. This is a painting my son did for me. He's my canary in a coal mine, he likes to call it. Kind of cool, actually. There's several indices that I look at in regards of trying to predict future contractions or recessions. Yield curve, natural unemployment rate, which is the low for the last 3 months versus the low of the last 12 months, manufacturing and consumer confidence. So where do we stand? These are the indicators. So we've all heard right now about what's called an inverted yield curve, right? This is something up until a couple of years ago, academics like me thought about. Generally speaking, no one else did. But now it's in common parlance. What does it mean? It means the interest rate on short-term debt is higher than long-term debt. And so you take the interest on 10-year treasuries, subtract 2-year, it should be a positive number. Well, it actually turned negative for a couple of months during the course earlier this year. When that yield curve inverts, you have 9 to 18 months traditionally before a recession happened. However, it reverted again. It turned positive again. Why is that? Federal Reserve. Chairman Jerome reduced Fed funds rate, and I think he'll reduce it one more time, probably either later this month or in January. And because of that contraction, we reverted. He's being essentially bullied by the administration. You've got the Fed should be autonomous, but however, they're being managed by tweet these days. And you've got a president saying, we've got to reduce these rates, got to reduce them. So they're kind of being bullied a bit. But that's why, because of that, we saw the inversion, but it reverted again. So when it turns negative, and if it stays there for 3 months, then that's a very, very good sign. The natural unemployment rate, right now we had a low of 3.5, we're at 3.6, therefore a spread of 0.1. That doesn't worry me. Gets to 0.3, i.e. when the unemployment rate gets to 3.8%, then start getting worried. Manufacturing, I would argue we are already in a manufacturing recession. And the ISM index, right now it's at 48, drops to 45, get worried. And finally, annual change in consumer sentiment. We're at negative 4.1 right now. If that gets to negative 15, then get worried. So what it really means is this. Yield curve did invert, but it reverted. We're not there yet on unemployment, manufacturing, or confidence, but we are heading that way. So the best case scenario is this. And it's about my forecast, 74% likelihood. The economy will grow through the course of this year. We'll probably see Q4 GDP at around maybe kind of 1.5, 1.6 probably, but it's still positive through next year. However, possibly we'll go the other way. This could happen. Now, it means we could have a business cycle recession, a contraction economically, middle to latter part of next year. But it's going to be okay. Recessions happen. It'll be very mild. It's a reset. This country's had 47 recessions in your history. You can never forget the Great Tulip Recession of 1698. Me. So it's out there. So it's unlikely, but it's possible. If it does, it'll be very mild. It'll be a reset. It could happen next year, but it is more than likely we'll actually see a push off into 2021. So big picture, trade wars. If there's anything that could pull us into a recession earlier, it's not fixing trade wars with China. Right now we are in a staring match with China. And if my mother told me one thing many years ago, it's don't do that. And we shouldn't. China is patient. I would argue right now, they're waiting to see who's going to win next November. And they can be patient. You see, China, President Xi Jinping is now president for life. He's going nowhere. Yet we as a nation work in 4-year increments between election cycles, okay? And they tend to take the long view. They could lose money this year, next year, 5 years from now. They'd look 10, 20, 50, 100 years from now. They'll see their GDP drop to 6.5%, tough life, and it'll be okay. And the reason why I know this is the first ever trade war that happened in the globe occurred between Russia and China started about 1710. They got it fixed. Took them 200 years to fix it. China is patient. And so if you looked, hopefully yesterday you didn't look at your retirement plans because it would have sucked. The Dow tanked yesterday. Why? Because the president turned around and said, you know what, we might not have this agreement with China anytime soon. The markets hated that. And they bounced back a little bit this morning, which is good, but there is great concern over ongoing trade issues with China. We'll add about 1.5 million jobs next year. Unemployment rate's going to pop back up a little bit, but still remain pretty good. And I think we will see palpable income growth. So if the glass half full or the glass half empty, I would argue it's probably still half full. But there are headwinds out there. And the big concern of businesses, nationally as well as globally, is US economic policy. And our economic policy right now is a bit shoddy, in my opinion. I mean, you've got Larry Kudlow, you've got Navarro, you've got these guys. And I know Kudlow, I've been on CNBC with him a lot of times. He hasn't got a forecast right in 40 years. I mean, Larry is clueless. I was on CNBC with him in 2008 and he said, oh, this drop in the housing market, it's a blip. I'm like, what? So, man, a little podunk guy like me saying, yeah, guess what, you're wrong. So it is uncertain. So again, with uncertainty, businesses tend to just hold back. And consumers, what's keeping our economy going right now is still consumption. We are still shopping. And 70% of the US economy is us buying stuff. And so if we start slowing down, and there are signs of that, that won't help, quite frankly. But it is more than likely we can continue to grow through the course of next year. All right, housing. This is why I'm telling you not to worry. I went back to the 1970s and said, okay, where are housing prices at the start of a recession? Where are they at the end of a recession? And what's the spread? Basically, house prices flatline through a recession. They did not last time round for the obvious reasons that housing caused the recession in the first place. So even if we see a slowdown, whether it's next year or whether it be the year after, I expect home prices just to hang out on a national basis, remember, not locally but nationally. So again, another reason not to be overly concerned by it. Existing homes, we saw a massive 12-month change in inventory, homes on the market. Had nothing for years, and last year we saw a significant increase. A buttload, economic term, of listings came online. What was going on? Investors. There was significant, back then we were seeing mortgage rates start to rise fairly precipitously. We got up close to 5% for a while. We saw home price growth start to slow. People were hedging the market. Like, we think we're done, now it's time to get out. So a lot of investors in single family and in condominiums kind of flooded the market. Now when they did that, we as consumers went, oh, what's going on? And what do we do when we're uncertain? We do nothing. We kind of take a step back. And that's where we were. But that has unfortunately bled away now. That big bump in supply is gone, and I'm afraid it will not come back next year. So for reasons I'll talk about momentarily. So we saw a weirdness here, but in general it changed. Now because of that, when we saw that increase, these are annualized sales, we were running about roughly 5.455 million per year. Dropped down in 2018 because big push in inventory, people got concerned. Then we started seeing mortgage rates contract again, listings start move off, and therefore we saw increasing demand. And so it's really very, very simple in that respect. We had a weird period of time where we just were uncertain. Then so mortgage rates started dropping, demand was clearly still there, it started growing again. And I think that will continue. Home growth rather of transactions will probably see almost as many, well, modestly more sales in 2019 than 2018, but about a 3% jump next year. So it is an increase, that's good. I'd like it to be back where we were back here. Unfortunately, that's not going to happen. It is going to be a very tight housing market in many metropolitan areas across the country in 2020. So the buyers that have been suffering from buyer fatigue, which we had a lot over time, bottom line is that people were looking to buy a house were getting called by their agents at 1 o'clock saying you've got to see this house by 2 o'clock or it's going to be gone. They're just getting tired of that. They're getting tired of writing the groveling letters to the home seller saying, please choose me. I was giving a speech in Denver and somebody showed me a letter. It wasn't from her client, it was from her client's dog. I love your yard. Please sell my own as your house. I think I threw up a bit in my throat. It got to that point. So the trouble, well, my point being, is that next year it is still going to be, it's going to be pretty tight in terms of inventory. In terms of home prices, will have increased by 4.1% across the country this year, and I expect a 4.2% increase next year. So the softening, we expect a lot more people expect to see negative values, and certainly there's some markets. Bay Area is a great example of that, where I do expect home prices to contract next year. Los Angeles is another one. I do not expect that to happen in most parts of the country, and certainly not if you look at the country as a whole. So when you look at this and say, well, we have this demand, why aren't people selling homes the way they used to? Here's a bigger reason why. We're living in our homes for twice as long as we used to. Back in 2000, we lived in our home for an average of just over 4 years. Now, it's 8. What's going on with that? Well, we're not moving geographically for our jobs as frequently as we used to, unless you're Californian. And Californians have no compunction at all. Their economy slows down. Kids, dog, car, move to Seattle. I'll talk about that in a bit. But we're staying put. And also, in addition, we're not downsizing when we're supposed to. Why? Because we're not retiring when we're supposed to. Now, until we choose to retire, we're not going to downsize. So we're not downsizing. The move-up buyers have got nothing to buy. And if the move-up buyers have got nothing to buy, the first-time buyers are shot. And that's where we are. Now, there's some other reasons as well. And there's one paper I'm writing right now, which kind of looks further out. So I want you to put yourselves in a situation that you are sat in your homes with your 3 5/8% mortgage, and the year is 2025, and mortgage rates are roughly 6.5% to 7%. Are you going to sell? It's going to be, I think it's a long-term endemic problem. I really do. And so what that tells me is that people won't move, they'll remodel. That's going to be good for obviously a lot of remodelers. It also tells me one thing: buy shares in Lowe's and Home Depot. It's going to kill it for years. But we're not moving. And so it's going to be, I think it'll be a longer term problem. See, if you think about it, you want to buy somewhere and it is 2025, it's a thing called the 1 in 10 rule. That means for every 1 percentage point increase in mortgage rates, your buying power decreases by 10%. You can afford to buy 10% less house. So I think it could be a long-term issue, certainly in the existing housing market for the next probably decade. You heard of the CaseShiller index? All right, Bob Shiller, friend of mine, correction, was a friend of mine. Bob won the Nobel Prize for Economics 2 years ago. Become a Nobel laureate, think you know everything. Became a pain in my ass after that. Anyway, it's a repeat sales index that looks at the sale of the same house over time. So you can clearly see bubble forming, bubble bursting. You're like, whoa, look at that. That's another bubble, right? Well, I take his numbers and I adjust them for inflation. So CPI minus shelter, and also I change them according to mortgage rates as well. This tells me one thing: we're still 6% below the pre-recession peak after you make those adjustments. So have we got room to grow further and not be overly concerned? I believe we can. That said, do I believe that we can continue to see 8, 9, 10, 12% annual home price growth? Not even close. Those days, those markets scare me to death, because they are unsustainable. So we're not making that much more money year over year to service that debt. I don't like it. But at the same time, I still think at a reasonable rate of increase of prices, that 4%, which is still above the 100-year average of home price growth in the US, we can still move up further without me being overly concerned. There are some cheap places to live in America. These are markets where people make, it's a percentage of households making median income that can afford a medium-priced house. Here's the kicker: no one wants to live there. I've been to Elmira, New York. Yeah, you don't want to go there. So a lot of Rust Belt states, Kentucky, Illinois, Ohio, certainly, remarkably cheap, but again, no economic vitality going on there. And that would be great if you want to go and buy a house for $100,000, less than in Cumberland. But again, the economies of those markets is basically not there. On the other end of the spectrum, where are the least affordable housing markets in America? Pardon? Outside that window. Not quite. This is where they all are. All in California.
Interesting.
You've got to drop down to number 15 to get one outside of California. That'd be Maui. And number 16, Bend, Oregon. Yeah. remarkable. It's insane, the lack of affordability there. So this is what is driving. Bay Area, less than 7% of households making median income can afford a median priced house, because that's the median price of a house. It's tough. And this is why on 405 you're seeing more and more and more and more California license plates. They are coming up here in droves. Why? Housing is half price. Apartments rent, half price. Office space, half price. And the economy down the Bay Area that's slowing down very dramatically already. So that's what's pushing net migration coming up here, very, very dramatically. Mortgage rates. Who remembers those wonderful days of October 1982? Mortgage rates were 18% plus points, 20, and we still bought houses. So the bottom shows the average per decade. Right now, this decade, which is obviously coming close to an end, just over 4%. Remarkable, and it really is. And my forecast going forward, we're not going to see 4% mortgages until 2021 at the earliest, in terms of conventional 30-year fixed. And it wouldn't surprise me if jumbo rates stay probably down sub 4 as well. So we start jumping. This is why when we started getting up here, which is why we started seeing more listings as investor sales I mentioned earlier on pulled back down as it did. Just don't see it going up. And quite frankly, the more concerns we have over China, then you're going to start seeing the price of 10-year treasuries go up, which means the interest rate on 10-year treasuries goes down. And anything you want to know about mortgage rates, track the yield on 10-year paper. That's all you need to know. There's a perfect correlation between the two. There's a spread between them because that's the risk premium associated between a bond, which has no risk, and a mortgage, which inherently does have risk. So, but it tracks that perfectly. So when you hear Fed funds rates going down, therefore mortgage rates go down, not even close. They don't bear any relationship with each other at all. But 10-year paper, they do. And the interesting thing is that...
10-year treasury?
What? 10-year treasuries? 10-year T-bill. So, and what, again, if you start seeing the economy slowing and certainly the equity markets start getting a bit overbought, people are going to start pulling money out and putting them into bonds because it's safer, which means the price of those bonds rises and the interest rate drops because there's more demand, and that in turn can mean a further lowering of mortgage rates. So mortgage rates are going to stay remarkably competitive, and we all think that, apart from millennials. They're like, no. Where's my 3 5/8 mortgage? This is daylight robbery. This is a rip-off. They've said it to me, believe me. I say the same thing to them. Sit down, grasshopper. Let me explain some things to you.
I'm here.
Whoops. Sorry, Siri thinks it's called grasshopper. All right, so.
Sorry, I missed that.
That's okay.
Could you say it again, please?
Be quiet now. New homes. We have this demand. We're creating households, and we are. So, excuse me.
I'm not sure I'm
Yeah.
Apologies.
You can apologize all you like. So if we're not building more, now you thought we're creating households. We're creating demand for housing. Why aren't builders throwing up sticks and bricks left, right, and center? Any builders here? Okay, that's right. Why aren't you building more?
Why aren't we building more? For one thing, school myths are killing us.
Okay, anything else?
And costs and our margins are compressing.
All right, good. All right. Now here's one. These are the 4 corners of housing development, right? If you are a developer like the lady at the back here, what are the things you look at? You look at these 4 things. You look at land price. And land price in Seattle, ridiculous, because we're not going to create any more land. We have urban growth boundaries. We have the Growth Management Act. We have mountains. We have water. We have a lousy mass transit infrastructure. So that's push up land prices. So example is, single family lot in Bothell today trading at $300,000. That means you've got to sell the house for $1.2 million to make a margin. I like Bothell. I like $1.2 million Bothell. So land costs across the country escalating. Labor costs. No one is learning to become a plumber, a carpenter, or an electrician. No one's going to vocational school. My youngest son is 15, and he is absolutely clueless. He could not drive a nail in straight for love nor money. William does speed mathematics. He multiplies big numbers in his head. That's what he's into. But we've lost a lot of people, labour-wise. After the recession, they all left the area. They all went fracking. Tough thing to say this time in the morning. Anyway, so after the Dakotas they went into the oil business and they're not come back. Again, no one's going to vocational school. qualified electrician in Seattle can make very, very good money. Pushes up the latest labor costs. Thirdly, material costs. What do the Canadians ever do bad to us? And I say this in all seriousness. Why? The Canadian softwood lumber tariff. We are putting a tax on imported lumber from Canada. Steel, aluminum, tariffs with China. PVC pipe, which by the way tracks perfectly oil prices, those are rising as well. Now we've seen some softening, which is good, but material costs are still remarkably high. And finally, my all-time favorite, regulatory fees. 25 cents of every dollar it costs to build a house in America are regulatory fees. 25 cents of every dollar are regulatory fees. So a friend of mine sent me a photograph. He's building a house in Portland. He just got his permits, and the permit cost was $48,000 for a single family house in Portland. So all these things, the trouble is, so what you've got is a situation whereby developers figure out the land costs, the labor costs, material, regulatory costs. They put some profit in there, spin it around a bucket, it will spit out a number you have to sell the house for to make a margin. Well, let's say that number is $1 million. But what if the market price acceptance point is 600,000? Are you going to build it? No. Did you build it in 2005? You better believe you did. What's the difference? OPM, other people's money. Builders were great spenders of banks' money. Now banks have become remarkably cautious. Construction loan you can get probably 62, 63% on total cost. You've got to have skin in the game. So developers, builders are being very cautious. Those that are building, however, they're building to the luxury end of the market because that's what they have to do to get the return. Yet where's the demand? Is the demand in the luxury end of the market? No, it's not. It's in the entry level market. It is those millennials, and I'll talk about them in a few minutes. So they're out there, but very few people. If you can figure out how to build to a price point, to that demographic, and still make money, you will die a very, very rich person. And that's one of the biggest issues we have right now. Oh, there they are. They're millennial types. So they are curious. What about millennials? They are America's biggest demographic by numbers today. Baby boomers thought they were the bee's knees back in the day. Nuh-uh. These guys outnumber you significantly. They're the largest demographic in the workforce today, which is massive. And here's the fun part. 1 million millennial women are having babies every year. As they do that, they are going to move out of their apartments and they are wanting to buy houses. The urban apartment thing is great when you're single or hooked up or whatever, but two things are important: safety and schooling. And you're not going to raise kids downtown, certainly not downtown Seattle, because of that fact. On the schooling part, sure, you can send your kid to spruce school and drop 50 grand a year on a 4-year-old, but other than that, you're not. You're going to start moving further out. So they're massive. Now, I looked at the percentage of millennial home buyers in some major West Coast markets from January through October. Pretty impressive numbers. Billings, Montana, half of all transactions, purchase transactions, this year to date have been to millennials. Do you think the number for Seattle, and by the way, Seattle is the greater Seattle metro area, King, Pierce, and Snohomish counties. Do you think the number is high or low? 46%. If you, as mortgage people, or even as brokers, if you're not working with first-time buyers, with millennials, figure it out. Because they are a massive component today of the housing market, and they are going to be a massive component for the next 5 to 10 years. Don't forget, it's not about millennials. Look who's behind them. Gen Z, born between 2000 and now. The earliest ones, they're going to start coming out of college in the next few years. So as we start seeing some softening in millennials, Gen Z is going to pick back up. And they do believe, 69% of these guys believe that owning a home will be the most astute financial investment they will ever make. And so they're out there. And it's all about it. So what does a millennial buyer in Seattle look like? 56% were male, 26 female. I know that doesn't make 100. That is the world in which we live these days. So, 54% were married. Makes sense. Double income, no kids, dinks, as we used to call them back in the day. That's going to help. Average age, they weren't the oldest. The oldest millennial turns 38 next year. They weren't the oldest. They were just over 30 years old. They borrowed about 400 grand, roughly. They bought a house worth around $500,000. and they put 17% down. Half are still going to the bank of mum and dad, and they are. Mum and dad are, however, less happy to get them out of the basement. No, they, what we used to have, we used to tap our lines of credit, help them out with the down payment. Now, of course, you cannot deduct that interest if you're not spending it on the house. So we're just being a bit more cautious, but we are still helping them out. But my favorite part of this is the bottom one. They got credit. Average FICO score is 741. And what's good about that, you've got to thank our generation. I sent my 2 oldest sons off to college, and I gave them both American Express card, and I said, I'll back it, but you've got to pay for it. But it started building their credit up early. Very, very important. So they have got credit. Now, they've also got $1.5 trillion of federal student loans, but yeah, what the hell? Those will be there forever, but they're out there, and they are. Now, what do they want? Millennials in Seattle, they want 12 to 1,600 square foot townhomes with dog showers. I'm not kidding you. They will drop $500 a month on the pooch for babysitting. They want a dog shower. They don't want the McMansions, don't want the space. They don't care about that. Millennials are very experiential. If I was to offer any millennial I meet and say, okay, I will buy you the latest 4K curved screen plasma TV, or I'll pay for you to climb Kilimanjaro, which will they choose? They'll climb a mountain, I guarantee it. So they're far less about stuff, and therefore have no interest in the space either.
But they take their dog shopping.
And they take their dog shopping as well, which is very, very true. So they're out there. All right, is there a housing bubble? Yeah, answer. And I'll run through this very quickly. No. Here's why. FICO scores on approved loans last month, the average was 754. We went from the sublime, where my dog qualified, to the ridiculous, where it's remarkably hard. Why is it remarkably hard now? Banks are making no money where mortgage rates are today. Therefore, they're making it hard. And that's just frankly the case. So we went from the sublime, anyone qualified, to the ridiculous, really, really hard. Secondly, foreclosure starts. It's very stable, below 100,000 right now across the country. It was very hard giving speeches back here. That's where my speeches end up going from lunchtime ones to nighttime ones. Why? Booze. It's a lot easier hearing an economist say, next year is going to suck more than this year, when you've had a couple of snifters. So, foreclosure down, 1/4 of all homes in America have more than 50% equity. What does that say to me? Back in 2009, 10, 11, mainly 9 and 10, banks had a thing called jingle mail. And jingle mail was that people were literally putting their house keys into an envelope and mailing them back to the bank and leaving. And it jingled. Now, why? Because there's so much negative equity. We are sat on a massive, massive amount of equity. And so even if you see home price growth softening, no one is going underwater. And therefore, again, that takes away that problem from the equation. And how much money we got? We're sitting on about $18.7 trillion of equity today. Because we've seen home price growth go up, mortgage debt, however, not. Far higher down payments. So we're sat, every home in America combined is worth about $30 trillion. We're sat on a ton of equity in the country. Again, trying to find bad things to happen, making it hard. But also it's interesting is this, the share of ARMs, adjustable rate mortgages. Back in 2004, over 1 in 3 were teaser rates, teaser loans, right? My all-time favorite, the 0 down option ARM with cash back at closing. What could possibly go wrong? Anyway, so in October, it was down at 5%. My job's to try and find bad things. Again, not worried about it. So no one's getting these teaser loans, obviously rates are so low, nothing like we were back in the day. So there's no bubble. Why? Very significant, very quickly. Qualifying's tough, mortgage rates, limited exposure to arms, obviously, a fine, demand's going to be good. If we were building more, that would cause existing home price growth to soften. We're not. We've got a ton of equity, and yeah, even through an economic slowdown, which I anticipate in the next couple of years, housing is going to be just fine. Not worried about it at all. Okay, so big picture forecast. Again, I think we'll see prices go up. This is still above the long-term rate. We're going to have another decent year in that respect. We'll see some new construction happening, but it's going to be nothing like enough. First-time buyers are going to be massive. Work with them because they are going to be a very big component. Now, First-time buyers, millennials, they might use technology, they might jump on the Zillow and what have you, but when it comes to pulling the trigger, they want an absolute ton of hand-holding. You'll know more about them than you probably ever want to know, but they will use full-service brokers for it. There's no doubt about it. All right, so that is the big picture economically, big picture in terms of what's going on in the US housing market. Let's start distilling it down a bit. This is my state-by-state forecast for economic growth across the states in which my company has a presence. I sit on the Governor's Council of Economic Advisors, and Governor Inslee loves this because look at where Washington's growth will be next year, significant. Slowing down in Oregon, significant slowing in California. Utah never has recessions. Colorado's starting to slow down a bit because of exposure to energy. But I will tell you a little hidden secret. Anytime New Mexico is adding jobs, all is right with the world. No one works in New Mexico. And they can grow by 1.5, it's fine. But there's another reason. There is a lot of money based back here that's saying, all right, where are we going to invest? And they're now looking at the Seattle market, without a doubt. There's a reason why we have more cranes in the air today in Seattle than in any other major market in the country. Now, I counsel several hedge funds based in Connecticut and New York, and back in the day, they said, oh, you're from Seattle, so you live in Southwest Alaska, right? Yeah, haven't heard that one before. Well, now they're looking to play in our sandbox. A lot of capital investment is coming here from the East Coast because our economy here is doing so remarkably well. Look at the major West Coast markets, the last 12-month job growth, Seattle's number one, just over 3%. This is a bit disconcerting. Anytime Tacoma's growing, something bad's going to happen. It always does. But then what we're actually seeing in Tacoma, significant number of startups are going to Tacoma. So it's actually creating a bit of a downtown there and a bit of a business center down there. So that's going to be interesting to see. And it's also partly because of home prices. But I'll talk about that when we get to the home part section. But again, Seattle doing remarkably well. My forecast for job growth will add on probably close to 50,000 jobs in the metro area next year. Very, very solid number. Why so high? Thank you, Amazon.com. Thank you, technology, the technology sector. Growing like a weed, and it's not just Amazon, it is LinkedIn, it is Google, it is Facebook, it is all these guys that are now opening up facilities here, and significantly sized ones as well. So I think our job growth is going to be certainly in the top 5 in the US for next year of any major metropolitan area. What are we doing? Information, obviously, because of Amazon, massive. Business services is doing well. Leisure, we're building a lot of hotel rooms right now, a big bump there, but these are very high paying employment sectors. Great for housing, and indeed great for the economy. Unemployment rate in the metro area is down at 3% right now. Tough place to be. Better than the state, better than the country. And if you break out the metro, i.e. King and Snohomish counties, King County is at 2.8% right now when you adjust it for seasonality, which the state doesn't do, so it's my own seasonal adjustments. So again, about as tight a job market as you can get. Again, why you're seeing people come up here from California, a lot of them. Remarkably tight. So right now, Amazon's got 6,000 job openings downtown it can't fill. 6,000 job openings. It's intense, quite frankly. Now, when you think about it, migration is interesting. And basically about, roughly 35,000 kids were born last year. About just shy of 20,000 people died. Births minus deaths gives you about 18,000 people year out, right? Births minus deaths. But what about people moving here from somewhere else? Then you had another 33,000 people last year came here from somewhere else. From California, from Oregon, and from Texas. By far our 3 largest net migration states. But we've seen it start to tail off in the last couple of years. Curious, what's going on? I know people are coming up here, I know we've got the jobs. Why is this happening? Well, if you break the metro area out into its 2 component counties, King and Snohomish, the massive drop is in King County, not in Snohomish County. Why? Home prices. Historically, if you could afford to live in King County, you did, right? And if you couldn't afford that, you jumped in your car, up I-5, until you found somewhere to buy. It's that drive to buy. It's why God created Marysville. It's true. Marysville is a massive bedroom community. Unless you work for the tribe, you live there and you work somewhere else. That, however, has started to change. Now what are people doing? They're getting their cars and they're going south. into Pierce County. Why? About a $95,000 delta in median home price between Snohomish and Pierce County. But then you're going to have that Federal Way commute north, which I would not wish on anyone for love nor money.
Always an accident.
Right, exactly. But it is heavily a price point thing. So I'm saying that's the reason why Tacoma right now is one of the top performing housing markets in the country, because of price. Who remembers this sign? Anyone?
So,
Probably. 1973. Real estate brokers from Hendricks and Partners in Seattle put this sign up on I-5. Pardon? Oh, pardon?
yeah. Boeing, they're saying.
Yeah, well, 1972. Why did they put it up in 73? The Boeing bust in 1972. We went where Boeing went. When they were growing, we were growing. When they weren't, we weren't. And so 1973 was the last year our area lost population. More people moving out than moving in, 1973. And it's a very bad situation when you specifically rely on one business entity. Because then you kind of, when they do well, we do well, when they don't. But it started to shift. Why did it start shifting? Well, there were two guys in a little podunk office in Albuquerque, New Mexico in 1974. A company that became Microsoft. And so Microsoft took over, certainly through the 80s and most of the 90s. They were the driving force. We are not going to see, so, yeah, ready? There you go. Right. Aerospace employment. We bumped up, when they started with the 777X, employment growth initially saw massive drops, but they've been dropping, and quite frankly, they are not anything like the player. They're important to Snohomish County, but they're not the player they used to be. And that's okay. A decade or so ago, if I'd have seen what's going on certainly with Boeing today, with the 737, which by the way, I think the FAA will recertify before the end of the year, domestically, but not internationally. I'm expecting zero employment growth at Boeing next year, zero. They're having a hard time as well. It's not just construction, they're having a hard time getting engineers. They're hiring people back out of early retirement. So it's a big problem. Decade or so ago, if I'd have seen this, I'd say, guys, buy canned goods, a gun, and move to Montana. Bad things would happen, but it doesn't matter anymore. Why does it matter anymore? We've diversified. These are just some of the companies that call Seattle home. We have been remarkably lucky. They all went to Lakeside High School together. It's great. And they happen to stay here. And so, even though Boeing can be slowing down, the diversification allows us to move forward. But certainly technology is a big thing. And how important is technology? Well, most of you are looking down on South Lake Union and obviously CBD. And there's a couple of the companies that are here. So Facebook is in, it says 800,000 square feet. It's actually 1.8 million. But until they formally announce two buildings, which everyone knows, including me, they're going to occupy, I can't put that number in there. So ultimately a couple of million square feet with Facebook. Then you got Google, about 1.6 million square feet. Who drives here on Mercer Street with any frequency? Good luck. You're going to have 4,500 Googleites coming out of there every day. You think Mercer was a mess before? No, you ain't seen nothing yet. I live kind of over, kind of here somewhere, and my office is just over here. I walk to work, and I can walk it quicker than driving it every single day. Literally, it's 1.2 miles. But who's the behemoth in South Lake Union? Right? What about Amazon? Yeah, seriously. They occupy just shy of 13 million square feet. It says 13.3, that's what they've committed to. There's about 48,000 Amazonians working downtown Seattle today. It's massive. And what is equally as massive, more importantly, in my opinion, is what's called the multiplier effect. For every job that Amazon creates, it creates an additional 3 jobs in the community. It's massive. And so they are, who here's got Amazon Prime accounts?
Half of America, I think.
That is the brilliance that is Jeff
Yeah.
Bezos. Every year we send him $8.5 billion for free shipping, even if we buy nothing. Absolutely. And he kind of needs it right now. It's going to be a pretty expensive divorce. But anyway, they're huge. Now, how is that changing? Well, technology is interesting. There's about 300,000 tech jobs in Seattle. We are probably certainly in the top 5 tech sectors in the US. It's massive. The economic value they create is massive, and it's not going to go away. It's only going to continue to grow as long as we can have the people coming out of UW that they can hire, and that's going to be very, very significant. Amazon was the behemoth, certainly, in South Lake Union, but that's changing. I looked at Amazon's office space in Seattle, the green bar, over time. But anyway, I just went back to 2000. We didn't grow that much, and then they moved off the hill into South Lake Union, started growing fairly exponentially. But look at the red bar. What's the red bar? You're here, Bellevue. I expect next to no growth at Amazon in Seattle going forward. I expect all of its growth to come on the east side. All of it. Why? They think City Council hates them.
They're not friendly.
They want predictability. They don't want head taxes. They're going to come here. Think about it this way. Come 2024, you could be at your office in Bellevue. You got a meeting at your office in Seattle. It's going to take you 17 minutes on light rail. Greater housing choices on the east side than in Seattle. Better schooling on the east side than in Seattle. Bellevue, I'm now calling it Amazon HQ 2.5. But that's what it's going to be. I don't think they're going to create another headquarters anyway. They're going to spread it out. Here, Portland, certainly Austin, and a few other markets back east. But the growth in Bellevue has the potential to be astronomical. Bellevue has become, in a business sense, a player. And it started really back in 1999 with Symmetra Financial, but I could talk about that for now, but I won't. But it's really becoming, getting into its own. It's going to make the east side remarkably, the vitality of the east side is only going to grow because of this. So what are the things to think about? We're going to see probably more B&O tax in the state. Capital gains tax is going to be talked about, certainly. So expect more taxation to be discussed down in Olympia. I'm in a lot of those conversations right now with the governor. We'll see how it all plays out. Rent control. Yeah, it is going to come up next year. Oh, well, it comes up, but I managed to keep Frank Chop behind closed doors and not be able to bring it forward. Given the fact that the Senate and the House are both Democratic now, it's going to happen. And it will be not pure 1945 New York rent control. It'll be similar to California and Oregon, which is the kind of anti-gouging measure. You can only increase rents by 7% plus CPI, whatever it is, sub 10%. So, but it is going to happen. Now, Frank Chop tried to get it out of committee for years. For years, I stopped it. I can't stop this. It is going to come up. GMA buildable lands, we're not going to add the amount of land in our marketplace. No, this won't happen. So because of that, what we need to do is try and understand density within those urban growth areas, which is what we don't get. City of Seattle, for example, 70% is zoned single family. That might have been appropriate in the 1950s when zoning was created. Is it appropriate today? Not even close. And so we have to start some very hard decisions on pushing zoning, really in the Puget Sound region more than any other area. I-976, the question is if it stands. We as a company thought it was abhorrent. I certainly thought it was abhorrent, and it failed in King County, but it passed elsewhere. People voted with their pocketbooks. But the trouble is the amount of money that will now not be spent on infrastructure, on bridges, on a ferry system, which is going to become obsolete in the next 20 years, is scary as all heck. And it will not help housing affordability at all. If we can move people around our region, you can build on land further out at a cheaper price point. There's a value to our time. We will pay more to live closer to where we need to be. That's what's making Seattle exclusionary as much as anything else. This is the problem. Will it get defeated? I don't make those kind of forecasts or prognostications, but it's going to take away a ton of money from the legislature. Yes, sir.
Could that ever reignite conversation about state income tax?
Yes, it will. State income tax, again, will come up probably next year. However, a state income tax will require a significant change to the state constitution, which is very unlikely that it will pass. But will it be talked about? You better believe it. Because we've got a massive shortfall here. There's some other things. So the US Supreme Court decided that the state of Washington has to replace every single culvert in the state. It's going to cost $3.3 billion to do it. We haven't got it. And I'm saying, well, hang on, you've got this big rainy day fund, use that. Well, there's a rainy day fund for a reason, for a rainy day. This is not a rainy day. And so this is very, in my opinion, very disconcerting. Now, do I agree that the way it's set up right now for car tabs is appropriate? No, I don't. I mean, I've got friends of mine that drive Teslas that are dropping $1,600 a year on tabs, which is insane if you ask me, but it is what it is. But do I think that $30 a year is appropriate? No, I don't. It's got to be a middle path. I just hope we can get there, because this is going to be it is already very troublesome. Region, again, employment's going to go well. Tech's going to continue to grow. Income growth will continue, probably drop off that 5% we'll see for this year down to 4.5. And yeah, we will do better here than I think anywhere else. Housing is the part that you're interested in. All right, so the metro area. CaseShiller, massive drop we saw. This is when the press were phoning me. Press never calls me when things are good. When things are bad, they love me. But we've ticked back up again. So you look at locally the CaseShiller index. Yeah, we saw this, but the trend has started to move back up again. Slowing growth, but growth all the same. And again, when you adjust for inflation, nominally we're up by what, 32%, 33 rather, 13.5% adjusted. Because it is Seattle, because we have a lack of land, also we have good jobs, that is still pushing home prices higher, but that rate of growth is slowing. And particularly so for reasons I'll get to shortly. So demand's here, so blue line is listings, red is sales, so traditionally within the 2-county area, about 3,000 transactions per month. You can see here, very significant spike in listings. That's similar to that we saw nationally, right? So all of a sudden people were hedging the market, mortgage rates were going up, concerns over price growth, and we saw that occur. But demand has really stayed very robust, which is interesting to see. And if you look at average list prices, we got to that silly time, almost 3 million dollars, down to just over $1 million. Again, 2-county combined, big amount of money. We saw that drop, but try like looking at longer term trends. Longer term trends tell you a lot more than month over month changes. The trend is still rising and will still continue. We just got out over our skis a bit too much back a year and a half ago. And because of that, we saw a similar situation on sales prices. Peak, we're now back up at the previous peak. Still up 5% year over year when you adjust for seasonality. If any one of your clients bought a house in 2012, it's probably worth double what they paid for it if you bought in 2012. Really quite remarkable. And that's because obviously of the crash we saw in 08. So again, the longer term trend, got a bit silly, but the trend still, it's very particular, says to me here. The big jump in listings, again, nationally similar, pulled back. We are not going to see much in the way of new inventory. Hopefully we will in the second half of next year, not the first half. Any spring jump you're expecting to see, I just don't see it happening. But I still think the sales will likely increase. Again, we're not moving as often, similar picture to that you saw earlier on nationally. We used to live in our homes for 5 years, now it's 10, for all the same reasons. My last graduating class at UW, my MBA guys and girls, I said to them, where are you going to move to? Chicago, Boston, New York? No, Seattle. I'm like, come on guys, go somewhere. No, they're staying here. Now if they're staying here, then mum and dads are staying here. To be close to their kids now and ultimately close to their grandkids down the road. So we're not moving away. When I first came to the States, one thing I learned really quickly is, when you retire, you bought a house in a place called Yuma, Arizona. It's where old people go to die. We're not, we're just hanging out here. And then that's going to be a problem with inventory if we're staying longer. Foreclosure filings, next to none, not worried about it. We're paying our bills, no one's filing foreclosure. We got almost 40% of us have 50% equity. That's massive. It really, really is. We're sitting on a ton of equity in our homes right now. Don't do it to me again. And it's my forecast. So.
Sorry, I didn't quite catch that.
No, you
Could you please repeat it?
Nope, won't repeat it. Go away. Don't like it.
Wonder why
Okay.
we started talking.
Wow. Lower price growth in 2019. Why? Again, because we got ahead of ourselves. And therefore we saw a drop in list price, therefore we saw a drop in sales price, therefore we actually compensated. So we're doing remarkably well. However, this year, not so much, because we overshot it in 2018, but it's going to pick back up to 8% next year. Very, very significant number, regionally speaking. So regionally, that's not me this time. Yeah, it wasn't me.
It's one of
Price will grow. Pardon?
Is that Seattle Metro?
That is, yeah, that is the 2-county area, King/Snohomish counties. So again, it's the changeover we talked about. Now people are looking further south. Do expect Pierce County to really outperform again next year. There'll be demand, there's no question about it. We're not building first-time buyers. Wish we did, wish we could. For a while we did back in, it was a few years ago. Back in Columbia City, Georgetown, those kind of markets, right? We were building some townhomes there you could buy for $450. Those units are trading now for over $800,000. See, back in the day, it wasn't that many years ago, Columbia City, I didn't stop. In fact, I sped up and locked my car. Now I don't stop because I can't find anywhere to park. Some of the best restaurants I've been to, I'm a foodie, they're down in Georgetown, Columbia City. So that's already happened. Where are the emerging markets? Burien, White Center. Now, if you'd have come to me 10 years ago and said, you know, Gardner, in a decade, you'd be calling out White Center, I'd say you were smoking crack. No way, no, south of Delridge, absolutely. So it is going to be more of those ex-urban markets, which I think are going to continue to evolve, continue to grow, south part of West Seattle as well. So I think there are still nodes. There aren't as many, but also areas that are proximate to light rail, proximate to mass transit. And mass transit stations, future ones. That's why I expect to see it. And yeah, we're going to start moving towards a balanced market. However, 2020 will still be, without a doubt, a home seller's market, not a buyer's market, any way, shape, or form. I'm probably going long, but if you bear with me for, let's back through Queen County. Do you have an interest in Snohomish County or not? Yeah, oh God, all right. Let's do it really quick. All right, we will not sell in King County as many homes this year as we sold last year, supply constrained. So I think we'll probably get up close to 20, well, a bit above 20,000, not that much more. So that's gonna be a tough thing. Again, so supply, very similar thing, about 2,000 transactions for 1,800 per month last year. Demand's very buoyant, supply is coming back down. It is gonna be tight. So if you're a home buyer, be ready to get out there, be pre-qualified, all these things. It is gonna be probably more important next year than it was this year. Listings, saw a big jump, again, same as we saw nationally and regionally, pulled back. I don't see it jumping up. It's gonna be very, very, very tight in most markets, and certainly in markets that are proximate to our job centers. List price again, we're down at 1.2 million, down from almost 1.5, but again, you look at that longer trend. However, getting the valuation of the home right is going to become increasingly important, and it really is. And for years we got away with asking, I pruned my rhododendron tree, my house is worth 50 grand more than the guy next door. Maybe not, but that is the attitude we've got. Pricing is right, and you get the pricing right, then a good, well-priced, well-positioned house is going to trade very quickly still. But home sellers still have a remarkably high expectation, which we need to taper a little bit. Sales prices again, we're back up essentially at that peak that we saw a couple of years ago. Almost say $100,000 for King County, a single family home. That's a lot of money. I'm not talking Seattle here, guys. Certainly not talking West Bellevue, but it is a lot. Affordability, housing is not affordable. It's an index I do at UW. Housing's never been affordable to first-time buyers. Not affordable to all buyers. This is a worry. And it's a worry for several reasons. The biggest one is companies coming here have two requirements: hire smart people. Check that box. Seattle is actually the most educated large city in America. So we got that. Number two is how much you have to pay people. Biggest component of salaries is what? Cost of living. At what point will companies say, I've got to pay people how much? Well, then markets like Spokane, Washington, Boise, Idaho, Las Vegas, Nevada become of greater interest to them. Why? You can buy a brand new, unoccupied, single-family home for less than $300,000 in any of those markets. Good luck finding a shoebox in Seattle for 300 grand. So we need to be very, very careful to try and address housing affordability. Permits, not putting enough permits. We won't reach last year in terms of single-family permits in King County. That means we're not going to see the new construction activity we'd like. But prices, low because we overshot the year before. Price in King County will still rise by 7.6% in 2020. So it's still a very, down to the last couple of hitting years we saw, still a big number. And again, the contraction, the low here, is because, again, the overshooting we saw in 2018. King County, again, psychology. Buyers think one thing, sellers think another. Price will rise 7.6. Supply, I'm hopeful, second half of the year will do better. Wages are going to go up by at least 4.5%, if not 5% in King County. That's going to help because mortgage rates aren't. And yeah, slow organic move to balance. When was the last time we saw a balanced housing market in Seattle? I will tell you, 1999. Think about it. 2000 through 2008, what were prices doing? 8 through 12, what were they doing? 12 through 19, what were they doing? Okay. It's been 20 years. A lot of people either haven't seen a balanced market or they've forgotten what one looked like. Snohomish, seeing as you guys want to talk about Snohomish, I'll do it. Again, we are unlikely to reach last year's transactions. Again, very, very tight. It will still stay tight next year. Still decent demand, about 700 units per month. Big spike, again, same as King County. Drop back, and again, I think is also going to remain pretty tight. We're down what? Year over year, 30, 35% change in listing activity. We could see some more mainly in East County and probably down the southwest, but that's going to be essentially about it. When you go further north, I mean, look at Whatcom County, for example, going gangbusters way up north. Retiree buyers, by the way, up in Whatcom County. Why? Drugs. No, I can get that. I can get edibles down the street now. No, sorry. They're moving up there to go across the Canadian border to get their prescriptions filled. That's it. Oh no, they're not. The edibles, no, you can get that around the corner. So a lot of moving further north. List price, again, we're off that high that we saw, but getting closer to it. But again, pricing is going to be important, even though it's cheaper. Sales prices, though, still irrespective, remarkably robust. Then we saw a couple of spots of weirdness, but other than that, that trend really has been quite remarkable, actually since 2011. Affordability, it is slightly, thank you mortgage rates, slightly affordable in Snohomish. For a first-time buyer, though, it is still not, even though going north. Again, the reason why more first-time buyers are going to hate it, they're going to start having to go south to buy. Dear friend of mine is the chief economist at Zillow, and we agree on a lot of things, Svenja and I, but the one thing we disagree about is that she believes that millennials want that kind of white picket fence, 2.4 kids and a dog. And I say absolutely, they do not want that, but they're being forced into it. They would like to have 1 foot in town, 1 foot out. They can't afford it. Therefore, they're being pushed further out rather than that being their choice. They do not want to become mum and dad. They really don't. Permits, we will probably match permits year over year, but again, it's still woefully low compared to the heady days we saw back before the recession. Snohomish County is going to be tight. It's still going to be expensive to build, no question about it. Remember, we're out of master plan communities now. We're done with them. There's essentially 2 left: Cascadia down by Bonnie Lake, and Black Diamond. But that's it. We're done. So there's no more master plan communities in the Puget Sound region. Period. That world's gone away, especially since warehouses got out of real estate. They were thinking about doing Snoqualmie Ridge Phase 2, which I worked on back in 2000, but they're now saying no. We like kind of watching trees grow better. So permits aren't there. Prices though, north of 8% price growth next year. Very, very significant figure. Finally, we'll see again, price will pick up. We were doing well because of expense in King County. That started to change, so we talked about that. Even though we're finding softening, obviously Boeing. Boeing is still remarkably important to Snohomish County. 1 in 4 jobs is at Boeing or aerospace oriented. It will suffer a little bit more because of that, but a lot of people are living up there but still working down in King County, an awful lot of them. Not enough first-time buyers again up there. And again, how are brokers going to explain the new reality to their clients? Understanding that's going to be very, very important, because a lot of them haven't seen a real housing market. With that, I will be delighted to take any questions that hopefully you might have. Yes, miss?
I have a question. So I think you said that you expect the market to become more balanced, and I'm
It's slowly
confused.
trending that way.
Slowly trending.
I mean,
And I'm
it's never gonna get back
confused
to
given
balance,
everything else you said, I guess.
Yeah, but it's a slow move back there. We're not there. We won't be there next year or the year after. But I think it is going to be a trend back from being just perennially a home seller's market. It's starting to become, I think, ultimately a little bit more competitive. But if for nothing else, price growth cannot continue the levels, even my forecast levels, because incomes aren't going up to match it. So it's going to be a slow change, but it's going to be slow. And so is it a change for a buyer's market? Not even close. Not here. Or quite frankly, anywhere on the West Coast. I do worry about Los Angeles. I do worry about San Francisco. I worry about Bend, Oregon. Don't worry about it being up here. But it's going to be a slow move. But what I'm hoping for is to say to you guys, 1 year, we're back to balance. But it's going to be really slow and organic, yeah.
Are you just saying because they just can't continue? 'Cause-
Correct.
Okay.
Yeah, that's
Right,
that's
people
it.
just can't afford it,
And
basically.
they can't, you're right.
So,
And then
okay.
ultimately, I'm hoping we'll see some zoning changes. We should see some more new construction activity going on. My example again, I mentioned Seattle. We think we're this dense urban city, right? Not even close. Take a map of Seattle, overlay it with a map of Paris, France, right? Paris basically covers up the same space as North Seattle with a bit of Kirkland. Now that means nothing, right? Because cities come in different sizes. Population of Seattle, 784,000 people. Population of Paris, 2.2 million. And they don't have high rises every other block. Generally speaking, it's 5 stories or lower. So we think we're this urban, dense metropolis. We're not. But the trouble is we have a bunch of NIMBYs, not in my backyard. I live on Queen Anne Hill. They're doing some rezoning on Roy Street and Mercer Street. Some of my neighbors are petrified they could lose their Space Needle view. Oh, the humanity. But the trouble is my neighbors are lawyers for Kernel Gates, Perkins Coie, Davis Right to Remain. They will fight it pro bono and they'll stop it. If you want to fix housing affordability in the city of Seattle, allow 1 duplex on every single block in the city. Problem solved. But it will never happen. Build your affordable housing, we want it. Build it down the Rainier Valley. And that's the belief. And it doesn't work that way. So unless we actually understand we need to change zoning, HALA, the grand bargain we did in the city of Seattle, is one thing, but that zoning change touched just 5% of that 70% single family zoning. Did nothing. And the trouble is we've got a city government who want to blame no one other than Amazon. It's Amazon's fault. Because Amazon hires people and pays them too much money. Last time I checked, that's kind of the capitalist way the world is, at least America. So we need to figure, I think ultimately we will get that part figured out. We'll start building more. We start building more, that's going to take pressure off resales, and then we're going to get to balance. But it's going to be, I think, a very slow, organic move. Somebody had their hand up there. You? Yep, okay.
How much exposure do you think Amazon had for our area in respect to how much they've grown?
And that's great. See, a lot of people think about Amazon, other than the fact we have a president that hates Jeff Bezos, but it's not for Amazon. He hates him because he owns the Washington Post. Simple as that. Amazon does not make money on you ordering garbage bags through Alexa. Okay, it doesn't. Amazon makes money through a group called AWS, Amazon Web Services, which basically manage almost every major internet website. It manages Zillow. They make gobs of money on that. That's not going away. I think that they are recession-proof per se, because I think that we are going to continue to buy our bits and bobs from them. But even if that starts slowing down, if you start seeing antitrust issues, which certainly Trump is continuing to talk about, that might hit that side of the business. It will not hit AWS. Now, is Amazon suing because Microsoft got the contract, a $10 billion contract with the Defense Department? Yeah. Have they got every right to do that? In my opinion, yes, they do. But I think that even through a recession, the thing is with Amazon, which was founded obviously for us buying books online, that was all we were supposed to do with Amazon. And it really was. Now, literally, I order my garbage bags on Amazon. If I have a pair of shoes that are falling apart, I'm not going to go running around the countryside trying to find another store. I'm going to try and look at the label. I'm going to go on Amazon. It's really built itself into our own kind of psyche. It's bizarre. So am I concerned? No, I think that their growth is not going to go away because the fact they're also global, not national. They're going to do a lot of interesting things over time. Driverless long distance trucks, big thing for Amazon right now. They're spending gobs of money on that. They're creating their own fleet of aircraft. They want to get away from UPS. So they're doing a lot of things, plus the fact they've got about $100 billion in cash that they're not doing anything with. So I'm not concerned about Amazon or any contraction there and any potential effect, because again, we diversify to a lot of different entities, not just Amazon. Yes, sir?
Just in terms of commercial downtown, WeWork?
WeWork.
Downtown Seattle, if WeWork implodes, how does that
What do you mean
impact?
if?
As WeWork implodes.
Yeah, WeWork. What an incredible business model that was. 2 things, one of which is we won't make money for 10 or 15 years and that's just fine. I wish. But more importantly, when they're doing their IPO, what was fascinating was that a bunch of analysts got together, because they take master leases on a lot of buildings, and then obviously they parcel it out. If you take all those leases and all those lease payments over the duration of those leases, they have $38 billion worth of lease commitments. They're Regis 2.0. I don't get it. And yet Newman's going to walk away with $1.8 billion for a failed company, tough life. So I think WeWork will implode. I think it's a business. I would argue that the company value is 0. In fact, the hedge fund put a note out 2 weeks ago saying that. Other people are saying it's worth about $8 billion, but I could see the zero argument, quite frankly. But I look at SoftBank and their exposure across the board. It's going to be fascinating to see how that plays out. Not just with WeWork, with Compass, with a lot of other entities that they've acquired over time. So we'll see how the business model plays. But I think even if they go away here, we're still, things about the office market, certainly downtown Bellevue and Seattle, two things. One of which is there's significant enough demand from other entities. We're still seeing construction activity at a reasonable rate, which invariably happens when your vacancy rates drop below 10%. They start building more. Very few are building spec though. You're building with an anchor tenant in place unless you're Michael Chris down in Renton. But and on Bellevue's Class A office space in Bellevue CBD, lower vacancies than Seattle CBD, higher rents than Seattle CBD. No one would have thought that before. Because companies now don't care. They can be in Bellevue, they can be in Seattle, they still call themselves in Seattle, right? And in Bellevue that changed when Symetra Financial created their global headquarters here in 1999. So it's really become a force unto itself. So I think even if WeWork goes away, which wouldn't surprise me, I think that any significant impacts on the commercial office market are going to be almost de minimis. Anyone else? Really? You have all been remarkably patient with me. Hopefully you got something out of it. I'll make sure that these guys get the slides out to you. Might not be till tomorrow because I'm afraid I've got to jump on a plane to San Francisco this afternoon. But when I get down there, I'll make sure they've got those. Again, hopefully you got something out of it, and hope you have, all of you, a great 2020. Thank you.
Thank you.